This video is sponsored by Masterworks, but more on that later. I'm revealing my $156,000 stock market portfolio, all 16 stocks. We're covering exactly how much I've made or lost from them, including any important recent news. Some I'm considering selling, others I'm buying more of, and I've got a trick up my sleeve for one in particular. For new investors and new viewers, hopefully you find some new stocks here, and for you longtime viewers, thank you so much for your support. I'm only able to do this because of you guys. So y'all can treat this as more of an update on my portfolio and moves I may make soon. Be sure to subscribe if you want in-depth research on new stock ideas that have 2 to even 25x potential, and let's do it. So I started this portfolio in June 16th, 2020, and I've been publicly sharing updates since it was at $30,000 to now over $150,000. Now, I did not 5x my money. I did add cash along the way. Don't worry, all will be revealed very soon. In fact, for the sake of transparency, I'll show you exactly what return we've made on this portfolio if you take away the effect of adding cash. To account for the addition of cash, we use something called the time-weighted return of my portfolio, and this is the time-weighted return since it was started, and we have nearly doubled our money in less than 2 years. In that same period, the market is up 46%, meaning we've doubled the returns of the market so far. Now, since the start of 2021, we're up 18.2%, which is great, but so far the S&P 500 is beating us through 2021. But there's still 2 months left and it's almost earnings season. Anyways, let's get into the stocks. But first, a quick word from our sponsor of today's video, Masterworks.io. The stock market lately has been in a frenzy with stocks trading at their highest valuations since the dot-com bubble. On top of that, the Fed has been printing money like it's no one's business, leading to a 5.4% rise in prices, the highest level since 2008. With all this uncertainty, investors are looking for ways to significantly outperform the market or ways to hedge against inflation. Well, what if I told you there was a way you could potentially do both at the same time? With Masterworks, you can. Masterworks allows you to invest in an asset class that you've probably never heard of, which has outpaced the S&P by 174% from 1995 to 2020. That's almost double the appreciation of real estate, gold, and 90% of cryptocurrencies during that same time period. The asset is contemporary art, and unlike the other assets I previously mentioned, almost no one is talking about it. According to Citibank, contemporary art has the lowest correlation to the stock market of any major asset class, and it is shown to outperform during times of inflation. And the amazing part is that with Masterworks, you don't need tens of millions of dollars to start investing in the artwork. For example, I think that this painting by Basquiat is going to appreciate nicely, so I simply select the number of shares I want to own and then buy them. I actually invested $500 into that painting I just showed you, and I can wait for it to be sold, or if I want my money sooner, I can sell my shares on the secondary market to someone else. If you want to take advantage and invest in some fine art as well as support the channel, then definitely check out the link in my description below. Additionally, by using my link, you'll be able to skip the current waitlist and start investing right away. Thank you to Masterworks for sponsoring this video. Okay, the first stock, our biggest gainer, up 310%, is Upwork, ticker UPWK. And I marked it red for this video because I may consider trimming my position, but I do not plan on exiting entirely. More on this later. As a quick refresher, Upwork is a platform that connects freelancers, agencies, and contractors with enterprises, individuals, and employers. Bank of America analysts recently initiated coverage of Upwork stock with a buy rating at $65 per share price target. That's about 15% upside from today's price of $57 per share. They're expected to report earnings almost 1 week from now on October 27th. Taking a look at their chart, it looks like it's been consolidating for a while now, which makes this next earnings report especially exciting considering how volatile the stock is and the fact that it's at the top of the range. There are 2 big misconceptions with this stock. First is the belief that Upwork is just another gig economy play that hires people for small, menial tasks here and there. The truth is, it's a highly professional freelancing service. In fact, 50% of today's Fortune 500 companies are clients of Upwork's. The company continues to grow quite quickly as well, with the number of clients spending money on the platform continuing to grow at over 25% for the past 2 quarters. Furthermore, client spend retention was 114%, meaning existing customers continue to spend more with Upwork. Spend retention has also been on a continuous increase since Q3 of 2020. Yes, their valuation is definitely high, a lot higher than when I first bought in, but that really only starts concerning me if it continues to shoot higher or if their growth starts to slow. This is their current growth plan to continue all of this momentum. In the near term, they're building brand awareness, gaining more enterprise clients, of which they currently have over 200, increasing wallet share and diversifying product lines. In the midterm, they will expand in international markets, probably diversify their talent plans, which are currently Freelancer Basic, Freelancer Plus, and Agency Plus, and over the long run, as the business matures, they'll focus on expanding their take rate on the platform. The second misconception is that Upwork has only done well because of lockdown. Well, this graph should be evidence enough that that is not entirely true. Their strongest increases in year-over-year growth for active client growth have come in the last 2 quarters when lockdown mandates started to become looser. That said, this is an important metric to watch for next week in their earnings report. Without digging into the numbers too deeply as we usually would on this channel, just be aware that starting a position here in Upwork does carry a bit more risk than usual at this elevated valuation. If it reaches more than 10% of my account, I personally may consider trimming it back, but not entirely exiting, just so that I can control my exposure and portfolio allocation. But now we reveal my largest position in the entire portfolio, Celsius Holdings, ticker CELH. Celsius is marketed as a healthier option to other caffeinated energy drinks such as Red Bull, Bang, and Monster. Searches for Celsius drink have actually overtaken searches for Monster according to Google Trends, now even with higher average search volumes. The company continues to take market share and actually gets a lot of organic free marketing. The most recent example being Jonah Hill's GQ interview with his top 10 things he can't live without.
My first essential, Celsius Kiwi Guava sparkling energy drink. And everyone thinks I own it because whenever you work with me, I get people hooked on Celsius.
Yeah, that was all completely free. They did not pay him to say that. It's now the number 7 brand in the convenience store category, surpassing Mountain Dew, with sales up 201% in convenience channels. And in MULO-C, which stands for multi-outlet channels like Walmart, CVS, and Target, they're the number 6 brand in their category, growing sales at 213% in those channels. They're expected to finish off the year by doubling revenues, and analysts see them maintaining a blistering revenue growth rate of nearly 60% through 2022. But don't be surprised if it's even higher. The business continues to grow incredibly fast, but they do have a couple of headwinds that we should all be aware of. First is, of course, the aluminum can shortage and supply chain issues that have been plaguing the beverage industry for about a year now, which could hold their growth back. Second is their net profit margin, which is rather slim at just over 5%. For comparison, Monster has a net profit margin of nearly 30%, but of course they're a much more mature business. These razor-thin margins could be written off or explained away by saying that Celsius is focusing on revenue growth right now, prioritizing that over profitability. The third thing to be aware of is their valuation. Celsius currently trades at 20 times enterprise value to next 12 months revenue, and all you need to know is for a drink company with low profit margins, that's pretty high. It's not like we're talking about some high growth recurring revenue SaaS business. It's even harder to tell just how high that is because there are pretty much no food or drink companies that are growing quite as fast as Celsius. Certainly not any of these competitors that are listed here like Pepsi, Coca-Cola, Monster, etc. The closest direct comparable is probably Guru Organic Energy, another publicly traded energy drink marketed as a healthier alternative. Guru is growing at 30 to 40% revenues over the next year, and they currently trade at 12.6 times EV to next 12 months revenues. So Celsius and its high valuation is the reason why I may continue to trim this stock over time and slowly reduce my exposure to it because it currently accounts to over 13% of my portfolio. But it does remain one of my highest conviction stocks over the long run. Number 3 on the portfolio is one of my newest stocks, but it's also up 263%, and you probably guessed it, that's Upstart, ticker UPST. I first covered this stock way back in February of 2021 when it was at $100 a share, which by the way is one reason you should probably subscribe to the channel. And right now I'm strongly considering selling out of this stock completely for a couple of reasons. But first, Upstart, if you don't already know, is leveraging the power of artificial intelligence to make unsecured personal loans more accessible and affordable to people with less than ideal credit. They help you get accepted faster, more frequently, and at better rates. To be honest, I think this is probably one of the best use cases for artificial intelligence and machine learning out there. Clearly, you can see the company is in a hyper growth stage with Q2 revenue literally jumping over 1,000% year over year, which is insane. And net income is improving from negative 6.2 million last year to positive 37.3 million, giving it a strong profit margin of about 19.2%. The way you find the next Amazon is you find a business that can easily expand into adjacent categories, and that is what Upstart can do, and that's what they're already doing with their fast-paced moves in the auto loans market and probably mortgages next. But it is just so darn expensive from a valuation standpoint. When stacked against SoFi, Lending Club, and Affirm, Upstart and Affirm are either both really overvalued, or SoFi and Lending Club are dirt cheap, or it could be a bit of both. The reason I'm considering selling is mainly because it is such a small position of mine, I'm treating it differently. If it was a larger position, say at $10,000 right now, I'd probably either trim or simply cut it in half and take some profit off the table and let the rest run. But because it's just 2.5% of my portfolio, it's not really worth trimming 1 or 2 shares, and I'm considering taking all of it off the table, perhaps even buying some SoFi. I'll keep all you subscribers posted. Next up is one of our best performing spec plays in the portfolio, that's NIO, ticker NIO. So the company's highlighted in blue here. I'm pretty much just going to hold them, so we'll breeze past those in this video for the sake of time. If you don't already know, this company produces electric vehicles primarily in China with autonomous driving capabilities. They're developing battery swap infrastructure, and they have NIO Power. They're often considered the Tesla of China. In their upcoming NIO Day, they're expected to unveil some new models, including one called ET5 and another unknown model, as well as its new brand for the mass market. In terms of expansion, they're expected to start sales in 5 more European countries following their launch in Norway this year. A lot of exciting things going on for NIO, and that brings us to the next stock in the portfolio, up 142% overall. That would be CrowdStrike, ticker CRWD. CrowdStrike is a subscription-based, cloud-native, artificial intelligence cybersecurity business. Have you ever heard so many buzzwords in one go? They are the market leader for modern endpoint security, ahead of names like Microsoft, McAfee, and more. What I'm about to show you is probably one of the most beautiful slides you will see as an investor. $1.3 billion in recurring revenue. 70% growth in annual recurring revenue, or ARR, year over year. 66% of their subscription customers are signed up for 4 or more modules with CrowdStrike, aka 4 or more products and services with the company. I bought into the stock when it was at about $791 million in ARR, and in just over a year, it's already on pace and close to doubling that number, and will likely surpass $1.6 billion in ARR within the next couple of quarters. Obviously, technology is not going anywhere anytime soon, so cybersecurity seemed like the clear place to at least have one play, and for me, that's CrowdStrike. All right, now we're just gonna start revealing them 3 at a time. How about that? Next up is the Trade Desk, ticker TTD, up nearly 95%. We've got Square, SQ, up 60%, and Callaway Golf, ticker ELY, up 51%. The Trade Desk is a play on programmatic advertising, which is essentially the automation of selling digital advertising spots. It allows its buyers to target a specific audience in real time with data-driven analytics. And in my opinion, the stock is also extremely healthy financially, which makes the Trade Desk, at least for me, a great stock to own. With Square, probably the most obvious recent news is their recent acquisition of the buy now, pay later giant Afterpay for $29 billion. And as this article suggests, the acquisition is pretty much so Square can acquire more Cash App users and merchants to develop those ecosystems. However, Afterpay is also a very strong business when standing on its own. For example, 2 out of 3 small or medium-sized companies who added Afterpay services to their business reported an increase in total sales and a hike of 10 to 20% in average order value. Additionally, about 90% of Afterpay's underlying sales are generated by repeat customers, with customer usage and loyalty rising the longer they're on the platform. And they're seeing this same trend or better as they expand into the US and UK. It's definitely going to be interesting to see how this one plays out and how Square utilizes this new business. Now, Callaway is one stock that I actually might buy more of in the near future. And by the way, this video took over 15 to 20 hours to research, record, and edit, so if you wouldn't mind just dropping a like, it would mean so much to me. Thank you so much. Let's keep going. So Callaway is a legacy business with a high growth business piled on top, and that would be Topgolf, which was acquired by Callaway last year, almost a year ago exactly, for $2.66 billion. As a whole, the company is expected to grow revenues by 16% next year, which for a somewhat mature business is a big deal, especially when you consider that the stock is trading for a price to earnings or PE ratio of just 9. That alone is enough to get me interested in potentially buying more of this stock. Taking a look at the chart, in my opinion, it looks like there should be some support at 26.65 or so. So if it drops there, I might consider adding, but at the same time, I'd love to see it also get above its moving averages. But back on the fundamental side of things, I believe Topgolf will eventually become a cash flow machine. But for right now, they are busy building location after location after location after location after location. Keep an eye out for ticker ELY. Our next three are Facebook, ticker FB, up 34%, Maxar Technologies, ticker MAXR, up 33%, and Zora, ticker ZUO, up 27%. Everyone already knows Facebook, so I'll try and share with you something that maybe you didn't know. Facebook is actually rumored to be changing its name as it tackles the metaverse as what looks like one of its main priorities for the future. The market responded positively because Facebook's current name is tied to so much controversy. Moving on to Maxar Technologies, the second name in this bunch here, it's an aerospace and defense company that builds satellites and provides the highest quality 3D satellite imaging. For example, they provide the extremely detailed imaging for Tesla's GPS satellite maps. I've really mainly only held on to this stock because I'm waiting for the catalyst that would be the launch of their Legion constellation. It's expected to be a huge driver for growth and profits, but the launch of the Legion was postponed to Q4 of this year, and it was actually just postponed again in August to March 2022. Maxar is one of my lower conviction plays because it is also, a bit out of my circle of competence, but I think it's worth holding on to at least until Legion, unless it gets pushed back again, then I may have to reconsider. Other than that, on the other fronts of the business, management does continue to execute. They continue to deleverage the business and continue to dig it out of the hole that it was put into back in 2018 with old management and that whole disaster. But moving on now to Zora stock, ticker ZUO, which powers the subscription economy. By that I mean they power the subscription management for companies like DocuSign, Zoom, Chegg, GoPro, HBO, IBM, and many, many more. In other words, if you believe that the future is more subscription-based, then this might be a good stock for you. I was in the red on this stock and down on this position for a while. Even after periods where I was green, I would end up red after like 4 or even 5 months of holding. But we did our research, we had conviction, we averaged down, and we recently saw a breakout. That's right. I actually recently just posted this as a stock to buy in October. That was right around here. And then it went on an insane rally that may or may not be continuing, up over 25%. For anyone who's been in this stock with me, this has been an incredible lesson in patience and how quickly a stock can move when it decides to move. Zora is another turnaround play for me, so it was absolutely exciting to see them report some of the best numbers in quite literally years. It was a big deal and a big win for us. So this one is another stock to keep an eye on. Now we have entered the red. First is my newest stock and newest addition to the portfolio, Lending Club, ticker LC. We're pretty much flat on the position because I literally bought it just days ago. We also have TTCF down 8.5% and the infamous TDOC down 14%. Before Lending Club, I hadn't felt the touch of a new stock in 6 months. In other words, I hadn't added a new stock to the portfolio in about half a year. Now the video before this one that I just posted is actually a full deep dive and full analysis on Lending Club explaining my full reasoning on why I bought the stock. But to give you the gist, Lending Club, similarly to Upstart, is leveraging artificial intelligence to supplement traditional credit metrics like the FICO score in order to originate and now fund unsecured personal loans. Now what's crazy to me is that it's growing just as fast, if not faster, than Upstart, and they're projected to do nearly identical revenue and revenue growth for 2022. So with that in mind, I had to bring up this comps table again. It just looks so cheap. Granted, Upstart does have significantly better margins, as we talked about before, so that may be why it's at a higher valuation, and SoFi has higher diversification of revenue. Lending Club is still in the middle of a transformation of its own, but I think it could be a big winner as I continue to potentially buy more. The next thing I need to do is do a lot more work on SoFi because they're probably going to get approved for their bank charter soon, so that's the main advantage Lending Club has over Upstart and SoFi right now. What happens after SoFi gets their charter starter? Do they suddenly become the superior pick despite the higher valuation? That's what I'm looking for next. Now really quickly, Tattooed Chef and Teladoc. Tattooed Chef is a high growth, primarily vegetarian food brand that offers SKUs in the frozen food category at the moment. Obvious next steps for this company to continue their growth is to expand into ambient products like bars and non-frozen snacks. Now the reason I have this highlighted purple in today's video is because I've actually been running a little option strategy on the side called selling covered calls. And before you ask, yes, I did also make a video on this explaining my plan to sell TTCF through selling covered calls. So here are a couple examples of trades I made where I collected over $150 in premium in total by using my existing shares to sell covered calls. If and when the technicals look favorable again to do this with TTCF, I'll probably continue to do so with my several hundred shares. And Teladoc is a telemedicine company that can help you with primary care, mental health, general medical, and much more. Finally, for our last two stocks, we have PLBY Group, formerly known as Playboy, ticker PLBY, down just 18%, and I say just because it used to be a lot more than that. And of course, Alibaba, ticker BABA, down 20%. PLBY has been a wild ride to say the least. I've been able to average down from my initial buys in the mid 40s to now an average cost per share in the low 30s. Meanwhile, this whole time, the fundamentals have only been getting better for the business. The biggest story right now is their new creator-led platform, Centerfold.com, which will soon rival OnlyFans. In fact, they were originally planning on launching Centerfold in the second half of 2022. However, they just made a $30 million all-stock acquisition of Dream, which is an existing creator-led platform. This acquisition means they can move up the target date of the launch for Centerfold from the second half of 2022 to Q4 of this year, the next few months. This acquisition not only buys them a faster timeline, but it also gives them a lot more technical and software-based capabilities with an entire dev team. Additionally, just days ago, PLBY announced the launch of their new Rabbitar NFTs. I believe NFTs are just a cherry on top for the business. I wouldn't really calculate this as part of my main thesis, and the real operations are in the direct-to-consumer shift, renegotiating license deals, expansion in India, etc., but this is also pretty neat. And to close it all up, we have Alibaba, ticker BABA at number 16. I don't think much needs to be said about Alibaba. Simply put, I'm seeing a lot of metrics that are telling me that it's technically undervalued right now, and you have a lot of super investors such as Monish Pabrai and Charlie Munger investing heavily, with Munger recently doubling down on his position. And I get it, Chinese stocks are not for everyone. If you don't like them, you don't trust them, or you think they're riskier, either don't buy any or just buy less. And if you're extremely bullish, you have full confidence it's all gonna blow over, then you can buy more if you want to. There's really no need to convince anyone else of either direction. So for that reason, I've decided my risk tolerance in investing in a Chinese stock, and Alibaba specifically, is about 5% of my portfolio, which means I won't be adding to this position at least anytime soon. I'm just going to let it hold and sit and see where it goes from here. Remember to check out Masterworks down in the link below so you can invest in some fine art. I personally expect myself to be investing more money with them soon, and use my link so you can skip the current waitlist and start investing right away. Subscribe.